Welcome to the April 2024 monthly MOTR checkup. My name is Dave Lundgren, and I am the Chief Market Strategist here at MOTR Capital Management and Research. Before we get started, please take a moment to look at our very important disclosures. Okay, so the title of this month's video is The Beauty and the Beast of Trend Following. And the point here is that, if we want to access long-term sustained uptrends, then occasionally we have to endure corrections. And I think that's what we've got going on now is that, corrections are the beasts that we must all accept if we want to capture the beauty of trends, so to speak. And, while we can anticipate these corrections and hopefully navigate them as they unfold, what's really, truly far more important is that we monitor the underlying structure of the market to make sure that the correction is not doing any damage to that long-term trend and not altering the context from bullish to bearish. So barring this, what we want to also focus on is setups. We want to be monitoring for setups that are developing during the course of the correction that's basically set the stage for the next move higher. And these setups, if we can identify them and then engage with them when they trigger properly, that's how we're going to rebuild our exposure for the next leg higher in the bull market. And in this regard, today the context does remain bullish. Although we're very early in this corrective phase, we can probably say that it only really just began this past month. So the setups are developing, but they're still very early. And so therefore, what we really want to do is be patient and wait for the proper triggers before we get overly involved in this corrective phase. And then the question, of course, is, will the Mag 7 survive this correction? And if they don't, will that matter? All right, so as always, let's do a quick rundown of the current market structure. As I indicated, we're beginning to see a bit of a correction unfold. This was something that we talked about even last month, I think, in this video, and then certainly in the monthly MOTR reports, this idea that if you're planning on doing anything about this impending correction, try to do it when the market was still overbought and not oversold as it is right now. I think right now is not a great time to really get too over your ski tips on shorts, certainly not on initiating new ones, and then not a great time or location to be liquidating longs either. And I'll walk you through that as well. But as it stands right now, this is the short-term risk gauge. It's down to a 7, which is just one above risk off. In an otherwise bullish environment, which you can see here, you get down into the 7 or maybe even risk off. That's an extremely oversold condition, or at least an oversold condition enough to warrant expectations of a bounce in this longer-term bullish context. We can see as the drivers of this deterioration in the risk gauge in the short term is, of course, that we now have a growing percentage of the market in actual downtrend in the short term. And so this is again, this is the weekly chart. So these are not hourly charts or 5-minute charts. So these are meaningful charts, but it's also, in the time frame that I'm really trying to capture as a trend follower, which are trends that last over multiple quarters, if not ideally years, if we do get a traditional bull market out of this 2-year melees that we've been in. Along the way, these types of corrections where you do get a lot of downtrends on the weekly chart, these are perfectly normal. What's more interesting to note as it stands today is that we also have 61% of the market cap is also in a clear downtrend. So this is not just hitting the breadth of the market, but it's also hitting the market cap. And I'll show you a couple charts that relate to that as well. Bigger picture, what's more important than the short term is the degree to which the short-term downtrends damage the medium-term and long-term trend. So we can see that in the medium-term trend, which again is a monthly chart, as of the end of March 24, we were at 49% in an uptrend. As of Friday, we're now at 34%, is the biggest bucket in an up base with a negative bias. So it's an up base, which means it's a uptrend. It just happens to be in a base, and it's got a slightly negative bias to it. So that's the biggest bucket. That's why it's colored blue here. So we can see that all this damage that's been done on the weekly chart, so far, all it's done is put the monthly chart into consolidation. And we have not done any sufficient damage at all, of course, to the long-term trend. We've seen some deterioration. We've seen a 5% loss in clear uptrends on the quarterly chart, but it's still colored blue, so it's still the biggest bucket. And if you look at the allocation across the buckets, it's the biggest bucket by far. So overall, we can see that this corrective phase, as painful and unenjoyable as it may be, is not doing any damage to the long-term trends. It is worth noting that consumer discretionary and tech have been pushed down out of the top leadership sectors in the momentum ranks. This is something we've been covering for a while now, and you can see that only 32% of the industries in the tech sector actually have a momentum score above 50. So there's quite a bit of damage being done in the tech sector, and only 17% of that sector right now is in a short-term uptrend, which compares to I guess it would be looks like about 35% if you add up all of this for the broader market. So it's taking quite a bit more heat than the broader market, and that's not bearish. It's just something we want to be mindful of, so that as we navigate this consolidation in this corrective phase, looking for proper setups, just be open to the possibility that we won't find them in tech. It might be more in these more inflation-sensitive sectors, industrials, financials, materials, and energy, which are leadership now. So something to maybe screenshot for the coming month, but of course I'll update these during the weekly motor reports as well. But these are the supports that we're going to want to follow for the primary indices: the S&P 500, the 400, the 600, as well as the Qs, as well as the main factors for the S&P 500. And what we can see is that all of them have actually gone into a downtrend in the weekly time frame. So this is just more indication that we've likely entered a correction that's going to last throughout the course of the summer. And we'll see these trades back and forth, that they should be tradable. If you want to be tactical and you want to put on some short-term longs, now would be a good time to do it, and I'll walk you through that. But also, if you haven't gotten short, or you have the ability to get short, I wouldn't do it now. I would wait for a trade across the range, which again, I'll show you what I mean by that and where I mean by that. But what I want you to focus on now is that as this is now in a downtrend, the focus now becomes on these higher time frame zones, these momentum zones and these support zones. So the idea is that let me just turn this back on. These as you break into a downtrend, your support zone on the monthly time frame now becomes the focal point. And this support zone, you'll notice, is resistance, momentum, and support. What distinguishes each from the other is that the support zone is the zone that needs to hold in order to keep this trend from breaking into a downtrend. So this is already in a downtrend. So if you close below here, it just continues the downtrend. This is in an up base, which means it's in an uptrend, but it's gone into a base of an uptrend. And to get this into a downtrend, it needs to close below this zone. The long-term trend, is still in an uptrend. If you close below this momentum zone, this trend, which is basically what the monthly trend is doing now, it closed below here, which puts it into a base, and now we're focused on support. But the long-term trend is still in a uptrend with momentum, as long as it's above the momentum zone. So it's 465 to 47. If we close below there, this trend does not go into a downtrend. It just loses its momentum and goes into a base, which you see happening here in the monthly. And then our focus would then become next on the support zone, which needs to hold in order to prevent that long-term trend from going into a downtrend. So what we notice is that as we're focused on this zone here, which would be the monthly zone that needs to hold in order to prevent the monthly trend from going into a downtrend, note how this zone overlaps with the momentum zone on the quarterly time frame. So that's the fractal nature of trend. And so we're really looking at this zone, this call it 458 to 487 zone, is the zone over the course of the summer that should likely be tested and should hold up and needs to hold up in order to prevent these trends from reversing. And you'll notice that the S&P spider right now is at 495, so you can see we're above here and we're above here, so this is good, and we just want to continue to monitor it as the summer goes on. And note that these zones are again, everything's in a downtrend across the board. All monthly timeframes are in a base, so these zones are critical across the board for the Qs, the mid cap, the large small caps, and the various factors as well. As it stands right now, It's all healthy. It's just corrective. This is something that we wrote about and anticipated might happen in the coming months. It's unfolding. Now that it's unfolding, this does not mean panic, because this is something that we kind of anticipated. We had these levels ahead of time. So as long as these levels hold up, we want to expect that we'll get through this summer unscathed, and we'll be positioning for the next leg higher in the bull market. And of course, through the course of the summer, we're going to get these oversold and overbought conditions, and we want to respond to those as long as we continue to hold above these support zones. Okay. So looking at the S&P 500 itself, this is the support zone for the monthly time frame. So we already know that the monthly time frame has gone into a range or base of an uptrend. So in order for this trend that you basically see here, in order for it to reverse into a downtrend, you need to close below this zone. This is a very similar zone that's set up and through here. It was tested and violated briefly, but managed to hold up. I think we're going to get some variation of the same type of action throughout the course of the summer. This is the support zone on the monthly time frame. This is the momentum zone on the quarterly time frame. So you can see how they're overlapping here. They did the same thing in here, and I anticipate that as the summer unfolds, this is the zone we're going to be testing. And you'll note that as it stands now, the 200-day is just starting to come into these zones as well. So that should add additional support in this zone. But along the way, what we'll find is that we'll get these oversold conditions from your traditional momentum oscillator. So here you have stochastics in RSI, and you'll note that when we get oversold like this, you get these bounces. You get nice bounces out of the market. We now have that for the first time since the beginning of the year in both oscillators. So for this reason, we should anticipate a bounce in the market just from an oscillator perspective, momentum oscillators. Looking at market breadth, which looks at the percentage of stocks that are above the 20-day moving average within the S&P 500, you can see that we're very oversold. So again, from a breadth perspective, we should anticipate a bounce. And then also from a volatility perspective, the VIX hasn't quite gotten to a level that we would typically see at a really durable low, but it is basically where it was in the fall and winter of last year. So we're getting there. We're not quite there, at least not from the perspective of what we typically see, but it's getting there. And then from a VIX curve perspective, we're just comparing the 1 month VIX to the 3 month VIX, or the volatility index. And whenever the 1 month volatility index gets above the 3 month volatility index, people are really starting to price the fear of a correction up front in the form of the 1 month volatility going above the 3 month. And so we're seeing that now. So you can see that this green box is 1 to 110, and you can see that the curve has kind of made its way into that 1 to 110 area. And again, that's where we typically see a bounce. So from this perspective, we should anticipate some sort of a bounce in the S&P from here as part of this ongoing corrective process. So where might we stall? Well, if you go back and look at that support, the resistance, momentum, and support zone page on the prior page, you'll see that 511 to 518 is the zone that needs to hold to keep this correction alive. So along with testing that zone, you're likely to find an overbought condition on the stochastic. So this is what we're going to be looking for, this confluence of entering resistance with an overbought stochastics that will trigger us to raise more cash, or actually introduce shorts if we have the proper setups for that. But as it stands right now, this is not the time for significant selling. That was back when the market had prior to having entered this corrective phase. Now that we're oversold, down about 5%, this is not the time to be selling. It's definitely not the time to be shorting. I'd rather wait for this reflex rally that I'm identifying here, and then put on any shorts or reduce any lagging trend structure that you have in your portfolio. But right now is not the time to do that. So with this, the bullish context still unscathed at this point, there's a few things that I'm going to be monitoring for, and opportunities that I'm going to be monitoring for as the summer unfolds. First and foremost, this is the most important, I'll be monitoring for buy setups for the next sustained move higher. So this is potential leadership for the next move higher, and they should set up as they traditionally do. They don't obviously set up the same exact way every time, but generally speaking, I want to just show you that this is how NVIDIA set up before it had that explosive rally this year. And this is the kind of setup that we'd be looking for, not just in NVIDIA once again, but in other potential leadership sectors and industries as well, materials and energy in particular. But the idea is that NVIDIA had a great run last year through the summer and into the fall, as we all know, having come out of a base. As with all trends that are this robust, they tend to get to a point where they're so extended above the 200-day moving average that they begin to feel this sort of magnetic or gravitational pull back to the 200-day average. Not that it necessarily goes down to the 200-day average, but it just begins to have this stalling out effect where it just meanders into somewhat of a consolidation. It's sort of in the best case scenario. And so as NVIDIA continued to hit new highs into the latter part of the summer last year, we began to see these divergences across those momentum indicators that I mentioned earlier, indicating that this is sort of your setup for a correction. And this is actually what led us into the current correction that we're experiencing now. This is I conducted similar analysis last month on highlighting a similar type of divergence that kind of led us into what we're in now. But you can see it playing out on NVIDIA last year. So the idea is that setup gave way to a multi-month sideways correction. And through the course of that correction, we got several of these oversold conditions that gave you the opportunity to take advantage of these tactical oversold conditions to either begin to accumulate positions for a longer term time frame hold, or at least for tactical buy and sell situations across the range. And one of the setups that really shined pretty well for NVIDIA last year was during the summer, in the fall in October. We got this lower low right here, but the stochastics did not hit a lower low. That's the kind of setup that we're going to be looking for, not just in NVIDIA this summer, but in any stock that's setting up as potential leadership for us. But this is what we're looking for. And ultimately, when one telltale sign that the stock is getting ready to go is that these oscillators have a difficult time getting into deeply into oversold condition. You can see the RSI here barely got below 50, and the MACD indicator didn't get below the 0 line. So these are the kind of indications to suggest that the momentum is coiling and getting ready to go. And of course, we know eventually NVIDIA broke out and it was a great setup, and off it went into the trend that we had throughout the course of this year. So in addition to this type of setup, I'm also going to be identifying and trying to identify these tactical trading buys as well as tactical trading shorts that will either show up in a setup like this, where we see these overbought and oversold conditions back and forth across the range, or something that's more damaging to the overall trend in stocks that are actually in a downtrend, where you can get a bigger bang for your buck on the short side. So those are the setups I'll be looking for this summer. So looking at NVIDIA today, now that the correction is now setting in, just to level set us and kind of like put a little bit of GPS on this. This was the beginning of the correction last summer, and this is where it broke out, just to kind of level set everybody. And what we can see now is the NVIDIA got pretty well extended above its 200-day moving average, kind of providing a magnetic pull back to the 200-day average as it typically does. And we began to see divergences in overbought momentum and momentum crosses that kind of led us into the current correction that we're in. And now we're beginning to experience, for the first time since the last breakout, we're beginning to experience oversold conditions again. So we're now beginning to see the setup evolve. It's not completed. We only have the first oversold condition, but this is, if you're thinking of getting short NVIDIA or selling NVIDIA because you're concerned about the fundamentals or whatever your reasoning may be, this is not the time and place to do that, because you can see we're into this oversold condition, and you're better off waiting for some sort of a reflex rally that gives you better pricing to lighten your position. Or if you're thinking about shorting it, then wait for an overbought condition to short it. But this is not the time or place to begin really selling NVIDIA, in my view. So the last setup lasted multiple months. It's conceivable that we'll see something like that happen over the next several months as well. And along the way, we'll want to make sure that those trend support, momentum, and resistance zones for NVIDIA continue to hold up throughout the course of this summer. And of course, that the 200-day average continues to rise and holds as support as well. So this is the kind of setup that we'll be looking for, not just in NVIDIA, but the rest of the Mag 7 and any other stock that's beginning to show us leadership characteristics and potential. And again, as I said earlier, energy and materials are really starting to show up in that favor currently. So looking beyond just NVIDIA, the rest of the management index, which you can see is an acronym for these leadership stocks that have been following for a while here. What we can see is that the index is still in an uptrend. So there's nothing bearish here at all. Again, as I said, it's just a correction. And corrections can last, let's call a correction 10%. Since 1970, there have been about 32 or 33 10% corrections. Some of them gave way to bear markets. Others just were 10% corrections that resulted in new highs to follow. And in our job between now and that 10% correction is to monitor to see if there's any kind of damage being done that would result in a bear market versus just a correction. But we have to handle that one step at a time. And the way we do that is we respond to overbought and oversold conditions along the way, monitoring the chart or the destruction of trend structure along the way or lack thereof. And as I said earlier, at this point, so far, there's no meaningful destruction being done in the medium term and long term trend conditions. So therefore, this oversold condition represents an opportunity for us to either take on tactical longs or cover short exposure. But more back to this chart here, what we're looking at is the motor management index remains in an uptrend, but we do have Apple and Tesla are both broken in their monthly time frame. So I've mentioned that everything's in a short term, most everything's in a short term downtrend right now, including Apple and Tesla. But in that medium term time frame, most stocks are still trending positively. We can't say that about Apple or Tesla. So this is something to be mindful of. Both of those charts are in a downtrend on the monthly time frame. So this leads us to question then, therefore, what if the management index actually fails and it actually breaks into a downtrend? Is the broader market doomed? And I've written about this in the past, and I've actually featured some charts in past videos as well. But I just want to remind you about the stealth bull market that happened between 2000 and 2001. Pretty much on the day that Cisco peaked, everything else bottomed. And I think the setup here is potentially similar to that, in the sense that we have what appears to be a bull market going on here, but it's really just driven by these Mag 7 and a few other stocks that make the market looks like it's in a bull market, but the reality is that it's still mired in this sideways range. And that's the same thing that happened between 1998 and 2000, where everything that was old economy was stuck in a range. Everything that was new economy looked like this. And then when the new economy stocks peaked at extreme valuations in March of 2000, Cisco, Amazon, Apple, Microsoft, etc., when they peaked, that is actually when the rest of the market bottomed and broke out of a similar type of a basing structure. So I'm open-minded to that. It doesn't have to be bearish for the broader market. I don't have a preference. What I prefer is to just to get it right? So let's just keep our minds open to some potential outcomes here. And then just, again, as I've said before, rather than be all caught up in forecasting this potential outcome, let's just handle this one overbought and oversold condition at a time, and one 5% correction and one rally at a time. And then if we just keep our focus on anything that's changing in trend structure along the way, we should be able to identify whether we should be getting out of something more sinister, getting out of the way of something more sinister, or if we should be preparing for the next leg higher. And the best way to do that is just to handle it one swing at a time. And at this point in time, it looks to me like it's healthy, and we're preparing to go higher as the summer unfolds and into the second half of the year. Okay, so one of the things that I think is a real problem for the Mag 7 is on multiple fronts is, number one, their extreme valuations. That's something I talked quite a bit about last month in the videos, and I've spoken and addressed several times in the various weekly motor reports and charting my interruptions. But it's this notion that inflation is sticky, despite Powell's belief that it was going to be transitory. I developed this chart, and I think it was in last month's video, and it's been in other notes as well. But the idea is that we've had these waves of inflation in the past, And I showed a chart as well of the 1930s to the 1940s, and we had very similar, we actually had 3 waves of inflation. So when you get this sudden burst of inflation, they don't tend to happen in isolation. They tend to happen in waves. And so we know that this go around, we had the COVID-induced inflation surge. We don't know, of course, what the event will be that causes the next one, but there's that risk. And so at the time, I was assuming that I'm not the only one on the planet with this information. I doubt very seriously I am, and I stated that I thought that the Fed must be looking at this information. And shortly in early April, actually, Powell gave a speech to the Stanford graduate school, and after giving a presentation on his current sort of policy update, he said that we think the risks are two-sided. If you cut too soon, the risk is that the progress on inflation will stop, or that it will even reverse. And we've seen that in some historical data, particularly in the 1970s. So I believe he's referring to this, and I think it's kind of obvious that he is. Now, he went on to say that we don't think that that's what's happening here at all, but that's a risk that we have to manage. Now, I'm not too relieved to hear him say that, only because he also completely it was a swing and a miss for him when he said that the inflation was transitory, and clearly it's not. So I don't get a lot of solace from the fact that he doesn't think that this is going to happen. But I think the fact that he's mentioning it is probably good enough for now, because it's an indication that he's not likely to do what the Fed did back here in the 70s, which is begin cutting rates when they shouldn't have. And so what I think he's doing is he's sort of speaking out of both sides of his mouth. He's trying to give the equity investors the hope and promise of Fed cuts later in the year, and trying to keep those expectations open, while at the same time acknowledging that there's this risk. And so he's just trying to monitor the data and not cut too soon, while at the same time not dampen the hopes that it'll cut again this year. So I think that's what he's doing. He's kind of walking the fine line. And to be honest, I actually I'm glad that that's what he's doing, because I think this is a very, very serious risk. I mean, you look at commodity charts, and it looks like there's a pretty pent up demand for a lot of these commodities that are starting to give way to pretty robust uptrends. Not across the board, but in enough places where it's definitely likely getting the Fed's attention. So Hedgeye, of course, offers a very scientific study on the likely future trend for the Fed funds rate. For a little humor here, but in the end, when you look at all the data, I do lean in the taller for longer direction myself as well. So something to keep an eye on. And I do think that if this is what persists, these massive Mag 7 companies that are the 10 largest companies in the world at their at these extreme valuations, I think that combination, it's one thing to be one of the largest companies in the world but be cheap. That's fine. It's another thing to be very expensive but not be one of the largest companies in the world, because these companies that have a $5 billion market cap but are growing 20-30% a year and have returns on capital that are very attractive and sustainable, I'm more comfortable paying a higher valuation for that. But when you have a $2 trillion company that's trading at a very high valuation, and you have the prospect of higher rates, it just becomes it's not a strategy that I want to repeat over time. This notion of buying very, very high valuation mega cap companies is just not something that I think is a durable strategy to conduct over time. And so therefore, if I don't want to do it over time, I certainly don't want to do it this time. Even, I'm trying to avoid the getting stuck in the trap of thinking that this time will be different, because I doubt that it will be. Okay, so just a quick summary. I often say that the market can only go up, down, or sideways, and for the time being, for the remainder of the summer, I would say, I think the evidence supports sideways. And so therefore, we want to maintain somewhat of a tactical perspective on the summer, buying weakness and selling strength. However that translates in your strategy, that's what I'd be thinking about doing. But the idea is that corrections, they're obviously not fun. They can be painful, but they're also a necessary evil. They basically reset expectations. They shake out all the bullish sentiment, and they truly set the stage for the next sustained move higher. So this correction, I would anticipate, will last throughout the course of the summer, and we'll get a series of overbought and oversold movement through the indices and the various sectors and industries. And that's the tactical opportunities that we want to kind of look for setting up throughout the summer, and the one that I believe is setting up now is a tactical oversold condition for those that are tactically oriented. The main point, though, is I would not be selling down here, and I would not be adding to short exposure down here. If anything, I'd be covering shorts and maybe adding to some tactical longs. Having said all that tactical stuff, the main focus is to make sure that as we go through this back and forth throughout the course of the summer, is that the corrective process doesn't do any damage to the long-term trends. And as I've said before, so far so good. And we just want to, as long as that's the case, we want to just really keep our primary focus on those stocks that are setting up to give us the kinds of opportunity that NVIDIA did last summer when it broke out. Or last summer when it was in its base and then eventually broke out, I should say. So this is a key point here, is that as this sets up, I don't have a strong view as to whether or not the Mag 7 stocks and others like them are going to participate or lead the next move higher. I frankly don't care. I just want to make sure that I'm able to identify it and do what the market says. But I just want to put it out there to be open-minded to the possibility that they don't, and that it's something else. And the sectors that I think are sort of leading the charge and offer the best setups for that kind of an outcome would be industrials, financials, energy, and materials. And they're currently leading right now. And there's a lot of great setups that are evolving, and I'll continue to show those in the weekly motor report chart packs. Okay, that's what we've got for you this month. As always, thanks for tuning in. I hope this was helpful and beneficial. You know, my email is here, so if you have any questions and you want to reach out on anything I've said in this video or anything that I write throughout the course of the month, please feel free to reach out to me anytime. Thanks so much.